40.23. That is the number that should concern every investor watching this channel. It is the Shiller PE ratio of the S&P 500 as of January 2026. The only other time in history we witnessed valuations this disconnected from economic reality was in 1999. Moments before the dot-com crash vaporized 80% of the NASDAQ. But if you believe 2026 is simply another cyclical market correction, you are missing the forest for the trees. We are not just staring at a recession, we are facing a convergence of four systemic failures: a sovereign debt death spiral, a commercial real estate implosion, a consumer credit collapse, and a geopolitical stranglehold on critical resources. While the mainstream financial press distracts the public with narratives of a soft landing, a silent, brutal war is being fought in the shadows. It is a war between the US dollar and physical reality. It involves the strategic maneuvering of China, the desperation of the Federal Reserve, and the one asset that stands at the intersection of industry and monetary history: silver. Why are central banks hoarding hard assets while encouraging retail investors to buy overvalued tech stocks? Why is the paper price of silver stagnant while physical vaults are being drained at record rates? Today, we analyze the mechanics of the coming collapse and why the world's largest institutions are fleeing into the metal that the system is trying desperately to suppress. To understand why the metals market, specifically silver, is primed for a historic repricing, we must first dissect the macroeconomic fire burning down the house. The narrative for 2026 is not based on speculation. It is a mathematical certainty, driven by four converging crises. First, the commercial real estate cliff. We are witnessing nearly $1.5 trillion in commercial real estate debt maturing. Between now and the end of 2026, these loans were originated in a zero-interest rate environment. They now need to refinance at double the cost. Simultaneously, office vacancy rates in major U.S. economic hubs have exploded to between 20% and 30%. The collateral is impaired, debt service payments have doubled, and the regional banks holding these loans are technically insolvent. This is not a liquidity issue, it is a solvency crisis. Second, the concentration trap. The equity market has become a dangerous hallucination. A handful of companies, the so-called Magnificent Seven, now represent over 30% of the S&P 500. Investors are paying 40 times earnings based on an AI boom that mirrors the 1999 internet bubble perfectly. The market is pricing in perfection in a world that is fundamentally breaking apart. When this concentration unwinds, there is no diversification to save the index. Third, the consumer breaking point. The U.S. consumer, the engine of the global economy, is exhausted. Look at the auto loan market, the true leading indicator of consumer health. Subprime auto delinquencies have hit their highest level since 1994. Repossessions are skyrocketing. When Americans stop paying for their vehicles, their only means of getting to work, it signals that they have already maxed out their credit cards and depleted their savings. The consumer has no capacity left to absorb a downturn. Fourth, the sovereign debt doom loop. The U.S. national debt has breached $38 trillion. Interest payments on this debt now exceed $1 trillion annually, surpassing the entire U.S. defense budget. The government is borrowing money simply to pay the interest on previous borrowing. In 2008, the Federal Reserve could print its way out because inflation was low. In 2026, with inflation sticky and debt to GDP at 120%, the Fed has no ammunition left. This vulnerability has not gone unnoticed. Across the Pacific, a rival superpower is capitalizing on this weakness, making a move that could shatter the US dollar's hegemony. This brings us to the core of today's analysis: the silent economic war between the United States and China, and how it is quietly cornering the silver market. The China strategy: dumping debt, buying resources. In 2008, China helped stabilize the global economy by purchasing U.S. debt. In 2026, the strategy has inverted. China is shedding US Treasuries at a rapid pace. By selling US debt, they force yields higher, increasing the pressure on the US government's interest payments and destabilizing the American banking system. This is a form of financial asymmetric warfare. But where is that capital going? It is not sitting in cash, it is flowing into physical commodities. Beijing understands a fundamental truth. In a sovereign debt crisis, the entity that controls the resources dictates the terms of the new economy. They are aggressively stockpiling gold, but more strategically, they are securing silver. The industrial monetary paradox: silver sits in a unique position. Unlike gold, which is largely hoarded, silver is consumed. It is the most conductive metal on Earth. You cannot have the green energy transition. You cannot have massive solar farms. You cannot have electric vehicles, and you certainly cannot have the advanced microchips powering the AI revolution without massive amounts of silver. We are currently facing a super squeeze scenario defined by three factors: the supply deficit. For 5 consecutive years, global silver demand has outstripped supply, mines are depleting, and ore grades are falling. We are literally running out of accessible silver at current prices. The paper illusion: the spot price of silver is largely determined on the futures market, where billions of ounces of paper silver, contracts with no physical backing, are traded daily. This mechanism has kept prices artificially suppressed, creating a false sense of abundance. The physical drain. While the paper price lags, physical inventories at major exchanges like the COMEX and the LBMA are hemorrhaging. Strategic accumulators and industrial giants are taking delivery of the metal, removing it from the system entirely. The corporate and banking maneuver. We must also look at the behavior of the major Western financial institutions. For years, banks have held massive short positions on paper silver. While this appears to be a bet against the metal, a deeper analysis suggests a different motive. Price suppression allows for the accumulation of physical metal at a discount. As the 2026 crisis accelerates and the US dollar loses purchasing power due to the debt spiral, capital will inevitably flee from financial assets like stocks and bonds into hard assets. Gold is the primary monetary shield, but silver is the volatile, high-utility asset that benefits from both industrial panic to secure supply chains and monetary panic to escape currency debasement. We are seeing a scenario where the green agenda of the West clashes with the economic warfare of the East. Western governments are mandating a transition to renewable energy by 2030, yet their high interest rate policies have crushed mining investment. China, controlling a vast portion of the processing capacity and supply chain, is tightening the noose. By squeezing the physical availability of silver, they gain leverage over the West's technological and energy future. The year 2026 marks the end of a 40-year debt supercycle. The soft landing narrative is a psychological comfort blanket designed to keep the public invested while institutional capital exits the market. The convergence of the commercial real estate collapse, the sovereign debt crisis, and the bursting of the AI equity bubble creates a massive liquidity vacuum. In financial history, such vacuums are always filled by tangible value, commodities, land, and precious metals. The suppressed price of silver is the calm before the storm. The depletion of physical inventories, combined with the strategic accumulation by China and industrial giants, suggests that the paper pricing mechanism is on the verge of breaking. When that link snaps, price discovery will be brutal and rapid. The question every investor must ask themselves is this: when the credit cycle turns and the banking algorithms freeze, what do you actually own? Do you own a digital promise from a government drowning in debt? Or do you own the essential physical assets that the future economy requires to function? The warning signs are flashing red. The debt is unsustainable, the consumers are insolvent, and the East is buying what the West is selling. So 2026 will not just be a crisis, it will be the greatest transfer of wealth in our lifetime. The only variable left is which side of the transfer you will be on.
They want you fixated on gold. They want you dazzled by the record-breaking numbers on tonight's financial news. It is a perfect magic trick. But while the crowd is busy chasing the glitter of gold, down in the vaults of the London and New York exchanges, a real bleed is taking place. Silver isn't just rising in price, it is physically vanishing from the system. This isn't about numbers on paper. The world is running out of the one metal that powers the green economy in the modern war machine. Today, I won't give you empty hype. I'm going to open the macro data files and analyze supply and demand to prove to you why we are facing the decade's largest structural imbalance. Welcome to the Strategy Report. Let's get into the data. To understand why silver is the most important story right now, We need to ignore the short-term noise and look at the big picture. Against a backdrop of escalating geopolitical tensions and global monetary policy uncertainty, the precious metals complex has recorded superior growth. However, there is a distinct divergence. While gold is successively setting new all-time highs due to frantic buying from central banks, silver is quietly forming a much more strategic price setup. My thesis today is clear. Silver is currently irrationally undervalued relative to its fundamentals. Let's start with the first macro factor, the safe haven role. Tensions in the Middle East and Eastern Europe are no longer isolated news events. They have become persistent risks. In this environment, smart money always seeks out hard assets. Although gold is the top choice for sovereigns, silver plays the role of a high beta safe haven. History proves that when gold rises 1%, silver tends to rise 1.5 to 2%. The second macro factor is monetary policy. The market is pricing in the probability that the Federal Reserve will be forced to ease to support the economy. When the tightening cycle ends and the dollar shows signs of weakness, that is the strongest tailwind for silver prices. But that is just the tip of the iceberg. The real story lies in the next section, supply and demand. Unlike gold, where most supply is stored in vaults and recirculated into the market, silver is an industrial metal that is consumed and extinguished. This is the key point that Wall Street often ignores. On the demand side, we are witnessing a shock from the energy transition. Silver demand no longer depends on jewelry or photography like in the last century. The current driver comes from the green economy. The solar industry is booming with next-generation battery technologies like TOPCon and HJT, which require a much higher silver content to achieve optimal conductivity. Add to that electric vehicles and artificial intelligence. You cannot run an AI data center or a guided missile system without high-quality semiconductor components, where silver is an irreplaceable material. But on the other side of the scale, supply is facing serious challenges. Here is a fact few people know. About 80% of global silver supply is merely a byproduct of copper, lead, zinc, and gold. What does this mean? It means silver supply is extremely inelastic. Mining companies cannot simply increase silver production when the silver price rises. They only dig up more silver when the demand for copper or zinc increases. Furthermore, we must address the CapEx crisis, capital expenditure, in the mining sector. For the past decade, under pressure from ESG mandates and low commodity prices, mining companies have drastically underinvested in exploration and development. They have prioritized stock buybacks over digging new holes. Here is the harsh reality. It takes, on average, 10 to 15 years to take a mine from discovery to production. Even if the price of silver doubles tomorrow, new supply cannot come online until the mid-2030s. We are facing a supply cliff that no amount of money can bridge in the short term. The geological reality is colliding with the industrial necessity. Data from the Silver Institute shows the market has experienced a supply-demand deficit for 4 consecutive years. This deficit is gradually eroding the visible stockpiles at COMEX in London. We are draining the final bars out of the vaults. So where is the opportunity? A professional investor doesn't look at price, they look at relative value and market structure anomalies. The East-West arbitrage. There is a critical anomaly occurring right now that demands your attention, the Shanghai premium. While Western markets trade paper silver, futures contracts to set the price, Eastern markets, specifically the Shanghai Gold Exchange, are trading for physical possession. We are seeing silver trade in Shanghai at a premium of 10% or more over the COMEX price in New York. This arbitrage window is a flashing red signal. It tells us that while Western hedge funds are shorting paper contracts, Eastern buyers are draining physical inventory. The smart money in the East is willing to pay significantly more to secure the metal now. This flow of metal from West to East is tightening the physical float to a breaking point. When the COMEX vault runs dry, the paper price will have no choice but to gap up to meet the physical reality. Now, let's look at the gold-silver ratio. Currently, this ratio is hovering around 85. That means it takes 85 ounces of silver to exchange for 1 ounce of gold. Let me give you some context. The average in the 20th century was only about 47. This indicates that silver is absurdly cheap compared to gold. According to the law of mean reversion, if the precious metals market continues its uptrend, silver has an upside potential many times greater than gold to narrow this gap. Regarding market sentiment, the Commitment of Traders report shows that large funds are holding net long positions, but they have not reached extreme levels. This is very positive. It means the market still has plenty of room for new money to enter without fear of being overbought.
However, as responsible investors, we must look at both sides of the coin. What are the risks? The biggest risk is a full-blown economic recession. Since over 50% of silver demand comes from industry, if factories close and manufacturing demand drops, silver prices will face pressure in the short term, unlike gold, which is a pure defensive asset. Additionally, if the Fed maintains higher for longer interest rates to fight inflation, the strength of the dollar will be a headwind hindering price appreciation. To summarize, based on the convergence of macro and micro factors, my strategic view on silver is bullish in the medium to long term. We are standing before a perfect storm. Monetary demand is supported by geopolitical instability. Physical demand is driven by the irreversible green industrial revolution. Meanwhile, supply is constricted by a decade of underinvestment and cannot react quickly. We are witnessing a gradual decoupling between paper silver prices and physical reality, evidenced by the widening Shanghai premium. As stockpiles continue to drop to alarmingly low levels, the pricing mechanism will be forced to reflect the true scarcity of this metal. My advice? Watch the inventory data and the arbitrage spreads closely. Do not let short-term price fluctuations deceive you. When the monetary system shakes, gold is the shield, but silver is the sword. Thank you for watching this report. See you in the next analysis.